Hello, everyone. Welcome to the Pinnacle Wealth Virtual Classroom. Thank you for joining us for our second webinar, 10 Tax Planning Tips Your CPA Might Have Missed. You'll find that in addition to the slides I will go through today, there are actually some other great resources you can download as well. There will also be a link so that you can watch this at another time at your convenience, or if you have others that you might want to watch it, you can certainly send it to them as well. So let's get diving in. As Kevin talked about last month, one of our core values and core passions here at Pinnacle is education. And it's through education, professional knowledge, integrity, and a personal touch that we strive to make the complex simple and to make a positive, meaningful difference in society, one financial plan at a time. So, in the spirit of education and planning, Ryan, what's on the docket for the second presentation in our virtual classroom?
Thanks, Nick. Hey, today we are going to dive deep into a topic near and dear to everyone's heart, taxes.
Absolutely.
Everyone loves taxes, right? But
I don't know who doesn't.
Who doesn't? All sarcasm aside, though, most of you have recently probably filed your taxes this year and may be thinking, I'm glad that's over until next year. Why do I want to learn more about taxes now? But at Pinnacle Wealth, we believe there's a big difference between tax filing and tax planning. Planning is a year-round, lifelong process. Planning is proactive. So today we're going to discuss 10 tips for you to consider if you want to proactively plan on minimizing your taxes that you pay into Uncle Sam for the rest of 2021.
Sweet. I'm excited. Let's rock and roll, man.
So the areas we're going to cover today, we're going to talk about a number of things, Social Security and tax planning, Medicare and IRMA planning, the new 199A deduction that came out of the Tax Jobs Cuts Act that we'll refer to here on out as TCJA, net unrealized depreciation strategies.
NUA. Our world likes abbreviations.
We do. Roth conversions, long-term care insurance, life insurance, the value of health savings accounts and to help with medical costs, the benefits of strategic tax giving and to charities through qualified charitable distributions or donor advised funds, and we'll finish it up with some asset location strategies. So a number of different topics that I'm sure you guys are all excited to learn about, but seriously, some of these strategies may save you hundreds or thousands of dollars. So taxes are a big part of retirement and financial planning, and there are a lot of strategies that could benefit your overall planning situation. A quick reminder here, any questions that come up while we're presenting this, you can email to info@pinnaclewealth.com anytime throughout this presentation. Due to different issues that we have in our industry, we cannot answer questions live on this. But if you email us, we promise we will get back to you within 24 hours.
Yep, you bet.
So before we get into all that, I want to introduce the hosts of your show today, these stunning young men. My name's Ryan Ovenden. I'm a wealth advisor here at Pinnacle Wealth.
I don't know who the guy on the screen is. He has more hair than I do. But I'm Nik Aamlid, another one of the wealth advisors here at Pinnacle Wealth. So we're excited to jump in with you guys. So let's go ahead and let's do it. First, we know everyone here is probably in a different phase of your financial journey. So we're going to try to have a little something for everyone today. But to start, what we want to do is we just want to highlight some of the changes to the individual income tax that have happened recently. Just kind of talk through some retirement tax hurdles. And then what we're going to do is dive into the planning items that Ryan introduced you to there. So the Tax Cuts and Jobs Act passed in the end of 2017, which became effective in 2018, was one of the largest overhauls in tax rules since the 1980s. So it was effective in 2018, but actually it may revert back to the 2017 rules come 2026, just on how long that act lasted. So some of the major changes that we saw in the Tax Cuts and Jobs Act were to the state and local taxes, or SALT, again, abbreviations, if you will. So the SALT taxes, deductions limited to $10,000 per filing on those. Mortgage interest was another one. That deduction was actually reduced. There's no more miscellaneous expenses over 2% for things like financial planning and attorney fees. And there was also an increase to the standard deduction, which actually helped a lot of families charities in our country. For those that did charitable giving, for tax purposes, the increased standard deduction made it a little bit less of an incentive to give. But what they did do, they did keep the charitable deduction, which was good. And in fact, you can now deduct cash contributions of up to 60% of AGI, your adjusted gross income, which used to be 50%. So they helped in that end. But again, with that increased standard deduction, maybe gave people a little bit less tax incentive to do it. But again, to get that 60% AGI deduction, you need to itemize to get that. So finally, the Tax Cuts and Jobs Act kept the previous 7 bracket structure that we had before, but rates and ranges changed. Some of the rates lowered and the brackets were widened. But at the end of the day, many people benefited from the increased standard deduction and a few from the lower tax rates as well. So those are just some of the changes. 3 retirement tax hurdles that we just kind of want to touch on here. Before we go on to some of the planning opportunities. Retirement and taxes really go hand in hand. We look at it and say there's 3 big hurdles in retirement with relation to tax planning. First is going to be your required minimum distribution, your RMD, which generally needs to begin after age 72. Used to be 70 and a half. Now they moved that to 72. This can cause taxes to increase because in many situations it's a forced distribution of taxable money. So that's one way that impacts taxes, and you need to be able to plan around that in retirement. Additionally, Social Security, which was funded with taxes, also is subject to taxes in some cases in retirement, and we'll kind of dig into a little bit more into that here into the presentation. But you can potentially see up to 85% of your Social Security benefits subject to taxes. So that's one that we need to plan around. And then lastly, Medicare premiums are also subject to potential increases due to compensation increases. So again, we're going to dive into each of those a little bit deeper in this presentation here. But for information's sake, for most retirees and those near retirement, the modified adjusted gross income, which is basically what the IRS uses to determine your eligibility for certain deductions, includes everything in your adjusted gross income. Again, we like our abbreviations here. So adjusted gross income we're going to refer to as AGI, and then modified adjusted gross income as MAGI. Anyways, MAGI is everything in your adjusted gross income except the taxable portion of your Social Security benefits. So it adds all the items, if you're looking at your tax forms on page 1 of your Form 1040, included in total income, except the taxable amount of Social Security benefits. Then it subtracts everything in the bottom portion of that page except student loan interest deduction, tuition and fee deduction, and domestic production activities deduction. So for most retirees, MAGI is AGI less the taxable portion of your Social Security benefits. So as we're kind of talking through some things, that's just one housekeeping item, I guess, to keep note of. So since we're talking about Social Security, Ryan, let's just start there and let's dive into some planning topics here.
You bet. Let's get into Social Security planning. So Social Security planning is a big deal because it is the largest income source for many retirees. There's a lot of uncertainty with Social Security too, and even fear when it comes to Social Security. Is it going to be there when I need it? About what might happen to this income source for Americans in the future. So before we let any preconceived notions creep in and start to cause fear and anxiety in your life, let's discuss how Social Security is actually funded and how it impacts tax planning. So our most recent figures come from 2019, where you can see that most of the funding comes from payroll taxes to pay for our Social Security system, while some of that income comes from interest earnings and some comes from taxation of benefits. So that 3.4% is a number to look at. The OASDI is a number to keep your eye on. It's an area that Congress may try to increase taxing more of the benefits that are paid out, especially for those who have other sources of income outside of Social Security. So if you're living on just Social Security alone, you're probably safe for the long term, unless Congress passes a bill otherwise, but you're probably safe to say that you're not going to get taxed on your Social Security income. But if you have IRAs, 401ks, other sources of income outside of your Social Security, there's a good chance that that Congress is going to have to make some changes to the Social Security system, and you're probably towards the front of the list.
Sure.
So if that happens, tax-free investments will become even more valuable, like Roth IRAs, which we'll actually discuss a little bit later.
Yep. Sure, you bet.
When you dive into the funding on the payroll side, you see that for those under FICA taxes, which means you work for an employer, you pay 12.4%, but it's split between the employee and the employer. But with the self-employed, you're under a different filing. You don't file under FICA. You're actually under SECA taxes, self-employed, the self-employed version of FICA taxes. So you actually pay the employee and employer side. So you pay the full 12.4% yourself. So for 2021, the taxable wage base is at $142,800. So you pay 12.4% towards the FICA or the SECA system on all of your wages up to $142,800. Anything over and above that, you no longer pay FICA or SECA. So this is another area to keep a watch on in the future for legislation. Could Congress require us to pay FICA and SECA on all of our income or a higher amount of our income? Under the Biden plan, they actually are going to add another FICA or SECA tax on any additional income over $400,000. So those are things that haven't passed yet, but keep your eye out on these. There's an opportunity, though, for us, if you're self-employed, to consider things like a solo 401k. If you don't have any employees, you can save a lot of money pre-tax, and all of the employer contributions avoid the entire 12.4% of SECA taxes. So this is a huge tax saving. So there's some opportunities there in the midst of, what is an ever-changing tax code that we have to live under.
Absolutely. Hey, quick question. Do you think we should give a quiz at the end of this on all the abbreviations?
I think so. I think we should.
I think so too. Okay.
Yeah,
all right.
should.
Just
We're
wanted
like
to make sure we establish
It's
that.
like the military. We have an abbreviation for everything.
I like
So now
it.
let's take a look at the maximum benefits at different ages for Social Security. If you look at this on the left-hand side, the maximum benefits for a single person at age 62, if you were to turn on your Social Security income, would be $2,324. For a couple filing jointly, the max you can receive if you turn on your Social Security, both of you, at full retirement would be $74,712 a year, and $93,500 if you wait until you're both age 70. So Social Security can see roughly 40% of those, roughly 40% of people receiving Social Security are paying some sort of taxes on that Social Security. So this is determined by a system that looks at modified adjusted gross income, or MAGI, and it also includes tax-exempt interest and your Social Security amounts to determine what's called provisional income. So if you guys need help determining what your provisional income is, we'd be glad to help you and sit down and figure out your actual situation. So once you have this number, you can figure out how much of your benefits will be subject to tax by using the Social Security provided ranges. So if you look at a single person filing or a single filing jointly, we can create income streams for you that pay you, say, $50,000 per year from your investments, but only $20,000 of that is taxable. Then you'll not be taxed on any of your Social Security income. So these are kind of some of the strategies that we can use to help avoid the taxation of Social Security, or at least kind of minimize that.
Sure.
Another challenge with Social Security and taxes is that an RMD can cause $2 to be subject to taxation. RMDs could push an individual into a higher tax bracket and increase the amount of Social Security benefits subject to taxation at the same time. Another issue is when one spouse passes away, new challenges develop at the death of the first spouse, because you lose a significant amount of your standard deduction because you go from a joint filer to a single filer. Mm-hmm. Then you also are generally going to be in a higher tax bracket as a single filer as well. So what does this mean? It means that widows could actually pay a higher tax rate on less income than when they filed jointly. It's an area of our tax code that needs to be changed, but nobody's addressed it. And widows have been dealing with this for years. So you add to that RMDs that you have to take out, and we've got what we call a tax torpedo for widows. How can we avoid this? We can proactively create tax-free resources, tax-free sources of income for your retirement. And there are a number of ways to do that, and we'll get into a few of those later.
Yep, for sure. All right, so number 2, what we're going to do is dive into the Medicare surcharge with some tax planning. Medicare premiums can also be impacted by income. So while they're not technically a tax, it does kind of feel like a tax sometimes. So again, our world's good at throwing out those acronyms, and we've done that a lot here today. But IRMA, which we're going to talk about now, stands for...
It's not your grandma.
It's not your grandma. No, it's not. It's actually income-related monthly adjusted amount, which grandma's going to want to know about.
That's right.
But no, that's not her.
Irma needs to know about Irma.
I'm glad we clarified that. I was a little nervous that people wouldn't pick up on that. So this is a surcharge added to the Part B and Part D Medicare premiums for higher income earners. So perhaps the most important thing to know about Medicare premiums is that going just $1 over IRMA brackets means you pay the whole new Medicare premium. It's not a prorated amount. It's not progressive. You go $1 over, and you're bumping up into those new premiums. So let's look at a projection of Medicare premiums and how the cost could be impacted by that increase in income. So as you can see, as income jumps over the ranges, the potential for premiums to jump a lot. It's pretty amazing, truly. And note, again, this is not a progressive tax, so you can see that just going $1 over the limit is the same as going thousands of dollars over the limit. And you guys can kind of see the impacts on the screen there. But just by looking up bumping up into the next brackets. Part B, you can see the increase in those premiums. Part D, you see the main premium there and then the surcharges that get added to it. And when you look at the 2021 annual premiums there, you can see just how much each step of income can change those premium payments. And it's pretty significant.
That's crazy to look at. The difference in premiums can be thousands of dollars per year.
Exactly. So that's just one thing that we want to pay attention to as we're doing tax planning throughout the year. So what are the tax strategies and planning opportunities for those in retirement? Well, as Ryan alluded to earlier, one of those strategies is to start accumulating sources of tax-free income. So, some of those you talked about a little bit, but those are going to be, taking distributions from Roth IRAs or Roth 401k accounts, withdrawals from health savings accounts used for qualified medical expenses. That's another planning opportunity there. Some of the other ones that you maybe don't hear about as much, but would be withdrawals of cost basis from loan or loans from a cash value life insurance policy that's not a modified endowment contract. We'll dive into that a little bit more here into the future. You could also, the portion of a withdrawal from a non-qualified annuity, that's the non-taxable return of premium. So those would be ones that if people have those contracts, we can certainly talk through. But those are some of the ways to accumulate that tax-free income. Second, you can borrow from a reverse mortgage. That's an opportunity. And then third, obviously limiting taxable RMDs by making direct transfers to charity. And you're going to dive into that one here in a little bit. But we talked about RMDs a little bit. So those individuals at age 72 that are required to take that minimum distribution every year can actually elect to take up to $100,000 in a direct transfer from the IRA and directly transfer that to a public charity. So those direct transfers count towards the RMD. So you're reducing that RMD amount that you have to take because you're giving it. And at the same time, it's not going to be included in your modified adjusted gross income then. So definitely preferable to taking withdrawals and then making a charitable deduction. So for those of you that have a charitable inclination and are already going to be doing some giving and maybe not necessarily needing that required minimum distribution to live on, this is a great way to reduce that modified adjusted gross income and still support those organizations that you're passionate about.
It's a great opportunity, Nick. Yeah, well, now we're going to dive into 199A deduction planning, and some of you are going, what? 199A deduction planning is new after TCJA, and it relates to small business owners. So if you're not a small business owner, this is not going to apply to you. But this is a really powerful deduction. One thing it is not is simple. It is very complicated deduction. So how do you go about determining 199A deductions? You have to look at a lot of things like ownership interest, if it's a pass-through entity, the phase out limits. So it's a very, very complicated deduction, and it's something that you're going to want to look for some help in determining this and making sure that you qualify for it.
Yep.
A big aspect of 199A planning is trying to get under the phase out limits so the 199A deduction is not lost. There are a lot of strategies for you to be able to do this. Sometimes it might be increasing W-2 wages in an S-Corp. There are some risks to that, though. You're always going to want to talk to your CPA about that. Sometimes it might be purchasing property that you currently rent or re-leveraging some of the debt that you have. Another option would be possibly using retirement plans to help you to be able to qualify for that deduction. However, if someone is not even close to the ranges, you might have to try another strategy. So this could include using like a defined benefit plan that would allow greater deductions. You can put up to $19,500 into something like a 401k, but with a defined benefit program, you can put away a whole bunch more than that. And so the biggest benefit is that a plan like a defined benefit plan may move you from the 37% tax bracket down to the 24% tax bracket, which would lead to huge tax savings now. So It's something that you do not want to just skip over.
Sure. Yeah, so kind of talking on the 401k lines and things like that. So net unrealized appreciation is kind of our next planning opportunity. But the NUA rules allow for preferential treatment of employer stock held inside of some of those retirement accounts. So how does it work, and what in the world does it mean? So NUA is all about trying to turn what otherwise would be ordinary income tax treatment of a gain in employer stock inside your retirement account, like a 401k or an ESOP plan, into long-term capital gains at distribution. So there's a lot of rules, like everything. You got to have rules. But for example, you have to do a lump sum distribution. You have to roll the stock into a taxable account. And it must be an in-kind distribution. So you have to take the actual shares of the stock and transfer those into that taxable account. But it can turn otherwise ordinary income into long-term capital gains. So you do pay ordinary income on the cost basis at the time of the distribution, but you don't pay the long-term capital gains on those the long-term capital gains tax on the gains until you actually sell that stock. So there's some planning opportunities there as we look to kind of impact income and obviously everybody's tax situation. So let's just look at one simple situation and kind of go through why it helps. So this is a simple strategy, but let's take our friend Joe at age 60, and he's one of the ones that gets to retire a few years early. 60. Nice. That's a
good
big
job,
one.
Joe.
Go Joe. So he retires, and we're gonna assume he's in a 25% bracket, ordinary income bracket, and that he's in the 15% bracket for long-term capital gains taxes. So Joe has a 401k with $1 million of assets. He's got $200,000 of those assets in other investments, and he's got $800,000 in employer stock. But he only has a $100,000 basis on that employer stock, so $700,000 of that is gain in that employer stock that he's received. So one strategy would be to roll the $200,000 to an IRA or a rollover IRA to defer those taxes, which is a more common planning approach. Then take the $800,000 to a taxable brokerage account where he's actually going to take those shares over there. So the $100,000 basis is going to be subject to the 25% taxes because that's his ordinary income tax bracket. So he's going to pay that now. And then if he sells the employer stock now, he's going to pay taxes on the $700,000 at 15% rather than the 25%. So that amount for Joe is going to be $105,000 in taxes. And if he would have if you would have done it the other way, you would have had $175,000 at the 25% ordinary income tax bracket.
That's a great savings.
By taking advantage of the NUA and using this strategy, you can make a big impact on the amount of taxes that you're paying for these dollars. So lost to the IRA tax deferral aspects, but now he has 15% rate on the future gains for those shares, and he also gets the stepped up basis if left to children. He's not going to have an RMD, and he didn't have to sell all the stocks at 25% at once. So you sacrifice a little bit in the tax deferral, but you get some pretty nice benefits in other ways as well.
If you have employer stock inside of your 401k, you need to come talk to us, because these are highly complex strategies, but they are highly beneficial strategies. You can save in the thousands of dollars if you do this the right way. One of the strategies we've used too is to, if you have charitable intent, to use this along with a charitable remainder trust, a CRUT or a CRAT. The CRUT actually gives you a deduction on the gift of the stock. When you gift it to the CRUT, you get a deduction. You can turn on an income source from that CRUT for the rest of your life, and then whatever's left in that CRUT gets paid towards the charity of your choice. But then it gives you the ability to take maybe this $200,000 that Nick talked about that you would have rolled to your IRA, and we can maybe start talking about maybe doing a Roth conversion. So we get rid of RMDs forever, and now we have a tax-free bucket. So that's one of those strategies that we can use multiple strategies combined to really create a powerful mixture that will lead to more tax efficiency on your side, and more money in the long term in the buckets for your heirs as well.
Right.
So there's some great opportunities out there, but it's really an individual to individual thing. So come in and talk to us about it.
Well, it's one that they don't happen overnight.
No,
so that's where we go back to planning, and you don't want to get caught by surprise. So these are things that you want to start talking about, well before you hit retirement, just so when you get there, you've got the strategies in place and you can move forward. So you talked a little bit about Roth conversions. So let's dive into those, and you can explain a little bit more what you mean there.
Yeah, Roth savings and conversions are another way to add to your overall tax diversification and planning strategies. So it's really important when we look at diversification, we don't just want diversified stocks that act differently, that have inverse correlations. We want to have diversification in our taxes too, so that we have some of our income coming in taxable and some of it coming in tax-free, so we can have some more control over our tax brackets no matter what Congress passes. And so having tax-free buckets is a great way to do that. And a Roth conversion may be something that benefits you greatly. So a Roth conversion can be a powerful tax planning strategy. Roth conversions allow you to convert traditional money into an IRA or a 401k to a Roth by paying the taxes that you converted today. So you pay on the taxes now, you let that thing grow, and later on, you pull those dollars out tax-free. So this can be a good way to add a mix of Roth tax treatment into your retirement plan.
Sure.
There can be a lot of reasons to do Roth conversions, including control over your RMDs. You are not required to take a minimum distribution out of a Roth IRA.
Yeah, that's big.
It can lower your taxable income in future years. It can help with estate planning. Your kids receiving a Roth IRA will receive that Roth IRA tax-free versus the 401k or the IRA that they have to pay taxes on. And it also adds tax diversification to your mix too. So this can be an effective strategy for people of any financial status. I don't care if you're a millionaire and you've got a lot of money, or you've got maybe $100,000 at retirement. This could be a strategy that we say, okay, maybe we do it all at once. Maybe we do small amounts where we're converting on a regular basis for the next 10 or 15 years, so that when we turn on our Social Security income, we're protecting that income as much as we can and diversifying it with some tax-free accounts.
Sure. No, that's good stuff. I like that, Ryan. All right, so now for the next two sections here, we're going to talk a little bit more about on the insurance side. So let's dive into long-term care first here. So there are a lot of strategies to fund long-term care expenses. You can use traditional standalone long-term care policy. You can use an annuity long-term care insurance hybrid policy, a life insurance hybrid policy. You can 1035 exchange an existing policy into a long-term care insurance policy or hybrid policy, or certainly just general savings obviously is an option as well for people. But the insurance-based approaches can certainly be beneficial because distributions for long-term care are generally tax-free, and that's kind of what we're talking about here today is the taxes. So.
Awesome.
So QLACs, this is just one strategy to kind of talk through, but another strategy that's not necessarily long-term care, and it's not a long-term care insurance solution, but still an insurance solution. That's to use a qualified longevity annuity contract, or QLAC for short, which is oftentimes referred to as a longevity insurance. Excuse me. So this can be purchased inside of an IRA or 401k, and basically at a flow of cash around age 85. So, well, it doesn't align with exactly when you might need long-term care. It could bring higher cash flow around the time that you do need long-term care services. So an additional benefit also is that the value of the QLAC is excluded from your RMD calculation. So what goes into there is not going to get calculated in that amount that the IRS is going to make you take every single year from your IRS. So it's going to be an income impact where you're going to have to pay less tax because you're not paying obviously the RMD amount on that the amount that went into the QLAC. So a good strategy from a number of different angles. Life insurance also is another planning opportunity. So we're going to dive into that a little bit here. So it's a valuable retirement planning and tax planning vehicle, really is what it comes down to. So life insurance can be used in multiple ways. First and probably most commonly, it can provide insurance in case you pass away to replace potentially lost income for the loved ones that you're leaving behind. That's obviously probably the number one way people look at life insurance. But next, can also be used for estate planning and legacy purposes to pass along income tax-free, a tax-free death benefit to your heirs. So next, if you no longer need your life insurance, you have a couple options there as well. One is to surrender it and just kind of let it go. You can sell it, which is a less common approach, but basically you receive the cash and give the death benefit up. There are new rules that actually increase the basis, so you pay less in taxes on that sale than what you used to. So maybe comes up in conversations a little more often than what it did previously. Or you can simply let the policy lapse, just stop paying it and let it go. But if you have a policy with cash value, you have a few other options that we kind of alluded to a little bit. You can use the cash value in retirement to help with cash flow needs in a manner that'll not be subject to tax. And in many cases, as long as the policy is not a modified endowment contract, you kind of do take that income, can use it as an income and not have it subject to that tax anyways. So. Or, obviously, too, as we briefly mentioned in the last section, you could do a 1035 exchange with that cash into a different type of product, which protects the basis. And actually, that becomes a huge tax planning opportunity with insurance contracts, is those 1035s, because you take the basis, turn it into another contract, and aren't subject to paying the tax on some of the growth that you had inside those contracts. So there's many 1035 exchange options, but maybe one of the bigger benefits is as your life insurance needs potentially decrease in your life, and at the same time your potential long-term care needs are increasing, you can look to exchange one policy for the other in an efficient manner, because life does change, and so we want to make sure that as life is changing, that we can do what's best for us in the current time that we're in. So utilizing some of these strategies can help you do that without subjecting yourselves to paying more tax than what you'd have to. So.
Amen.
All right, Ryan, we're going to move on from insurance. So what's...
Darn, I know. You guys are all sad. Yeah. We're going to talk about HSAs next.
All right.
So HSA stands for Health Savings Account. Health savings accounts are growing in usage and popularity in part because of the tax benefits. There are some great tax benefits. HSAs have really special tax benefits. First, you can make tax-deductible contributions. The investments can grow tax-free, and distributions can come out income tax-free if used for qualified medical expenses. So this can include things like healthcare costs and Medicare premiums in retirement. We call this the tax trifecta, though. Anytime you can have tax-deductible contributions, allow something to grow tax-free, and then take it out to pay for something tax-free, you are totally eliminating the taxes on that. So this is a strategy that that we recommend a lot of doctors, dentists use. Sure. As having an HSA as part of your health insurance plan save that money into an HSA, invest it. You can invest it into something like a checking or savings account, or you can invest it in the market. And we encourage people, save in that thing, and if you don't need it, leave it put. Look at this as your retirement health account. Okay, so these premiums can come out 30 years from now. You can grow those dollars over the next 30 years and use those to pay for long-term care insurance premiums. You can use those to pay for your glasses, pay for your prescription drugs, even sometimes pay for your Medicare or Medicare premiums. So there are a lot of options for these HSA accounts, and it's a great option for lowering your taxes right now.
Sure.
So let's go over the limits for using HSAs. A big downside for retirees is you really can't fund this anymore in retirement. So once you enroll in Medicare Part A or B, you can't contribute to an HSA anymore. So you got to do it while you're working. I strongly encourage clients who have the opportunity to fully fund their HSA every year, but to avoid pulling that money out like we talked about earlier. Just pay for your current medical costs out of pocket and save into that HSA. There's nothing saying that you have to take money out of the HSA once you've put it in. Another couple of opportunities here are called QCDs and DAFs. So I hope you've been taking good notes. We've got a lot of acronyms for you in our quiz afterwards. But QCDs are
a hard one.
Right. Qualified charitable distributions and donor advised funds can be great ways to give to charities and improve your tax situation. QCD stands for Qualified Charitable Distributions and can be a way to give money out of your IRA directly, like Nick mentioned earlier, to a charity and not have the amount counted as taxable income if you're over 72. So instead of writing that check out of pocket to your church for your tithe, or writing that $1,000 check to that ministry that you support or that organization you support in your community, instead of doing that, maybe consider taking your taking qualified charitable distributions and giving those directly to the charity from your IRAs, and then not taking that income on. It's going to be a great way to help avoid Social Security taxation during retirement, which is going to be a big deal.
Well, it is, and it's always it's one of those where it never hurts to ask the question, even if you're not sure that you can use one of these options. Never hurts to ask the question, and once you learn about it, to encourage those that you love to do the same, because this is one of those things that so few people take advantage of that more people should. So you guys need to learn about it. You need to ask questions about it. If you can apply it, that's an amazing thing to do. But also share this stuff with the people that may be impacted by it as well.
That's right. Donor advised funds, DAFs got a boost after the TCJA Act. So you can donate money to a donor advised fund and take the whole deduction in 1 year, even though the donor advised fund won't distribute the money all in 1 year. So you can put money into a donor advised fund, which is technically a nonprofit charity, take a deduction for that year, but leave that money sit and grow and decide where you want to give it to later. This is helpful if you're near the limit for itemizing deductions. So if your standard deduction is $28,000 and you've got $26,000 in itemized deductions, it may be a good year to consider a bunching strategy. Okay, so for example, instead of giving a tithe of $500 a month to your church, you could donate $50,000 of cash, or appreciated stock would be even better yet, to a donor advised fund. You can take the full deduction for this year, which means you'd be itemizing instead of taking a standard deduction for this year. Then you could give to the church each month from your donor advised fund in the same amount that you would have given it anyway. You could also consider a Roth conversion to eat away at that $50,000 deduction that you got that was created by your gift to the donor advised fund. So there are some strategies that can, when combined together, make something even more powerful than if you just have them separate. And that's where I think tax planning really becomes powerful, is when you can start combining different strategies for your individual needs. And that's what we try to do here at Pinnacle Wealth.
Right. And it's just been one of those that I think it's been ingrained into us that everybody thinks that in order to support an organization, you got to write them that check.
That's right.
And there's so many other strategies that you can potentially employ. So
that's right.
Deploy. So just that's a big one. So yeah,
Absolutely.
those are exciting ones. Now we're having fun.
Now we're having fun.
A good time. Lastly, number 10 here, we want to talk about asset location for tax planning. Simply, where should you hold your investments and assets? So asset location really does become that question of where you should hold the assets. So first, retirement accounts like IRAs and 401ks get special tax deferral treatment. So often it's beneficial to have annual taxable investments. Bonds are one of those obvious ones that you can hold inside those accounts that get that tax deferral. On the other side, though, stocks already get good long-term capital gain treatment. So holding those outside of your retirement plans because of those long-term capital gains rules is not necessarily a bad idea sometimes. But keep in mind, obviously our tax code is always changing, and so those things at any given moment can change quickly. So, but as we talk here today, the long-term capital gains treatment of stocks is a good thing, and not all bad sometimes to hold those outside of your IRA accounts. But there are some benefits too. There are benefits to putting those bonds, like we talked about, inside those qualified accounts and your other annually taxed assets into those tax advantage accounts. But the Roth IRA kind of gives you some opportunities to sort of benefit from both sides, where it also has some value when it comes to those high growth assets because of the tax free nature after 95. So to really try to ratchet up the growth inside those accounts to take advantage of the fact that as long as you leave it in there or you use it for a qualified expense, you're never going to have to pay tax on that money. So your Roth IRA isn't a bad way to give yourself some leverage and really try to see if you can get that thing to go, obviously fitting within your risk tolerance and all those things. But the Roth IRA gives you some value on each side there. So in terms of legacy to heirs as well, both the Roth IRA and that current stepped up basis rule that we talked about with the stocks really give you some value there in terms of passing property on to the heirs in a really tax efficient, favorable way. So those are both powerful tools and ones that certainly would be interested in talking through with you guys as well. So, anyways, that's a wrap. I mean, we covered quite a bit of information there. That was a lot of stuff.
We covered a lot. So now is the test time.
So are we going to give them the quiz?
We're going to give them the quiz.
I'm not sure I could pass the quiz.
Actually, you're going to have to come into the office and get the and take the quiz. And if you pass the quiz, I can tell you, Miriam has a hot cup of coffee waiting for you. It's got your name on it.
There you go. That's perfect. That's perfect. So to wrap up, paying taxes can reduce cash flow for retirees, obviously. So that's kind of what the whole topic has been today, is how some different strategies we can employ there. So we don't have to pay any more taxes than what we're legally required to pay. So if there are some strategies that we can put together that reduce the amount that we're going to have to pay in taxes, why not look at it? So there are lots of strategies that can help manage taxes in retirement, but again, tax planning and rules will continue to develop and change. So you always got to be sure to talk to your tax professional and just make sure that you're up to date on the retirement planning, the tax planning, and consulting with them before you make any big decisions. That's
absolutely
that's
crucial.
a big one.
Crucial,
Yep.
And that's one of the things that I think you'll benefit from is finding an advisor who works directly with your accountant too. And that's one of the things we strive to do here at Pinnacle Wealth. You want to have your advisors communicating with each other. Very, very important for your future health financially.
Right. No, absolutely. That's a good point. So to wrap up here, as Ryan alluded to earlier, no one necessarily likes paying taxes, although, generally if you're paying taxes, it means that you have income, which is a good thing.
Always a good thing.
So the key to remember is that there are a difference between tax filing and tax planning, like Ryan talked about right at the beginning. So with as much as things are changing and evolving, it makes it so important to do good planning and certainly keep up with the times. So if you have questions about your specific situation or you just simply want a second set of eyes, we'd be absolutely thrilled and happy to sit down with you and either look at your current plan or even help you begin to build out a tax planning plan that we can help you come up with for your own personal situation. But the big thing, like anything, is your peace of mind. And oftentimes your peace of mind is going to come with your confidence in the plan that you have in place. If you don't have a plan, that's where we start to get anxious and start to wonder if there's something we should be doing. Well, let's talk about that. Let's address it, and let's try to get a plan in place to help you walk on the path that's gonna build you confidence. So.
Right. So we're happy to answer any of your questions and focus on your concerns. Currently in this format, as we discussed earlier, because of confidentiality and regulatory compliance, we are unable to address any of those questions live. So that we can address your specific questions, just shoot us an email at info@pinnaclewealth.com or call our office directly at 605-271-6023. Again, that's 605-271-6023. Or you can call us toll free if you're out of our coverage zone at 866-575.
Is that what that's for?
2500, I guess. I don't know.
All right.
Can you hear me now? I don't know. Anyway, we have an 800 number, 866-575-2500. Give us a call. So if you've enjoyed this format, feel free to share it or pass it on to those important to you that you believe will find this valuable. If it's important for you guys to have a proactive game plan for your finances in life, we would love to help design a plan for you inspired by your core values, passions, and purpose. Remember, it's not what you make, but what you do with what you make that often can make the difference.
Absolutely.
So have a plan with a coach and accountability partner so you raise your financial confidence and enjoy life. You define it. We design it. Thanks for joining us today. We hope to see you soon.
Thank you guys so much for joining us. We appreciate you all.